Hello everyone, and welcome back to the channel. Today we're breaking down one of the most important financial topics that impacts millions of people worldwide: mortgage rates. Whether you're a first-time home buyer, a real estate investor, or just curious about how interest rates shape the economy, understanding mortgage rates is essential. So let's dive into what they are, why they move, and how they directly affect your money. What are mortgage rates? At the simplest level, a mortgage rate is the interest you pay on your home loan. When you borrow money from a bank to buy a house, the bank charges you an annual percentage, let's say 6%, on that loan. That rate determines your monthly payment and how much interest you'll pay over the life of the mortgage. For example, a $300,000 mortgage at 3% interest costs about $1,260 a month. The same mortgage at 7% interest, that jumps to nearly $2,000 a month. So even a few percentage points can mean tens or even hundreds of thousands of dollars difference over 30 years. What determines mortgage rates? So, what makes mortgage rates rise or fall? The Federal Reserve, the Fed. While the Fed doesn't set mortgage rates directly, its policy decisions heavily influence them. When the Fed raises interest rates to fight inflation, mortgage rates usually rise. Bond market. Mortgage rates often follow the yield on the 10-year U.S. Treasury note. If investors demand higher yields, mortgage rates climb. Inflation. High inflation erodes the value of money. Lenders demand higher rates to make sure they aren't losing purchasing power over time. Economic growth. Strong job markets and consumer demand push rates up. Recessions, on the other hand, often push them down as central banks cut rates. Historical context: mortgage rates have seen wild swings over history. In the 1980s, mortgage rates were over 18%, crushing affordability. In the 2010s, they hovered near historic lows, around 3 to 4%, fueling housing booms. In 2022-2023, as inflation surged, rates spiked back above 7%, putting huge pressure on buyers. As of 2025, mortgage rates remain elevated compared to the past decade, but they're slowly stabilizing as inflation cools. Why mortgage rates matter to you? Mortgage rates impact far more than just homeowners. For buyers, higher rates mean higher monthly payments, reducing affordability. For sellers, fewer buyers can afford homes, which can push prices down. For the economy, housing is a massive driver of growth. When borrowing costs rise, construction slows, sales decline, and the ripple effects hit industries like furniture, appliances, and finance. Simply put, when mortgage rates move, the entire economy feels it. Fixed versus adjustable rates. Not all mortgages are the same. Two common types. Fixed-rate mortgages, FRM. Your rate stays the same for the entire loan. Great for stability. Adjustable-rate mortgages, ARM. Your rate changes over time, often starting lower but adjusting with the market. Riskier but sometimes cheaper in the short term. Choosing between them depends on your financial situation and how long you plan to stay in your home. So mortgage rates aren't just random numbers. They're shaped by inflation, the Fed, global markets, and economic conditions. And they have a massive influence on affordability, the housing market, and the broader economy. Now the big question: do you think mortgage rates will go higher in 2025 or start to come down? Drop your thoughts in the comments. And if you found this explainer helpful, don't forget to like, subscribe, and hit the bell for more financial breakdowns, investing insights, and economic deep dives. Thanks for watching. I'll see you in the next video.